So, hello everybody, and welcome to our Growing Future Assets Competition Masterclass on looking for growth and making your investment case. I'm delighted to introduce our speakers for this evening. Sarah Whitley is the chair of Future Assets. Before her incredibly busy retirement a couple of years ago, she had a very successful career in fund management, running the Japanese desk at Baillie Gifford. Sarah's won a number of industry awards for her outstanding long-term investment performance, including the inaugural Lifetime Achievement Award at the Women in Investment Awards in 2017. Promoting diversity has been one of her key interests since retirement, but she's also training to row at master level at various events and is president of the St Andrew Boat Club in Edinburgh, as well as being involved in several other charities. Sarah was recently appointed, or it was a bit more further ago than recently, I think, but she was appointed External Director of Rakuten in Japan, making her one of the very few British women to serve on the board of a major Japanese company. So I'm going to hand over to Sarah to introduce our other main speaker tonight, James Anderson.
Thank you, Helen. I'm delighted to introduce my former colleague, James Anderson. James and I were colleagues at Baillie Gifford. I was working it out, must have been 35 years from when James joined until when I retired. So that's quite a long time. I think we're both believers in growth investment, perhaps in slightly different styles. And James, you probably know, is a very famous and distinguished investor, particularly well known for managing Scottish Mortgage, and very well known for buying some of the great growth companies in the world before they were very obviously the great growth companies. He's also a supporter of a number of charities and good causes, from Youth Orchestra, Sistema to Hearts Football Club. So over to you, James.
Thanks, Sarah, and it's a pleasure to talk to you again. And I think the fact that, and I think it is a fact that we had slightly different ideas about how to growth invest is very encouraging. As you know, there isn't a set pattern at all, and it's the ability to think differently that matters most here.
So before we start asking you some questions, we just wanted to know, James, did you always want to go into fund management?
No, I didn't. All I wanted to do was not be a doctor or a nurse, because everybody in my family was, and it used to particularly annoy me. Friends of my parents used to say, it can only be that your son isn't intelligent enough that he doesn't want to be a doctor. So I was desperately seeking something different. And I think probably what I did know was I thought the chance to indulge one's curiosity about almost everything was something that I was looking for. But that might have just as well made me end up as a journalist as a fund manager.
So it was the questions that you liked to ask. And that was what led you to fund management.
Yeah, I think the questions is really important in all this. And I don't know, my perception would be that Sarah would agree with this, that it's something to do with the open-mindedness of the questions rather than you're imposing your view on the people you're talking about. You know, I think it's really important to listen and learn. You know, I think one's objective is very often to be the least intelligent person in any room, because that's how you move on. And unfortunately, I succeed in doing that quite a lot.
I'm sure that's not the case. But what would you say? So a key skill is listening. Then, what would you say are the other key skills that you need as an investment manager?
Well, I think one of the critical and underestimated parts of the role is to do with actually building up trust with the people you're talking about. That, you know, trust is so lacking in the investment management industry with very short time horizons, and companies are so desperately looking for that ability to build a long run relationship that I think getting to that position is really important and really differentiated. And one of the biggest pleasant surprises to me, particularly over the last 10 or 15 years, and Sarah had absolutely done this with Japanese companies before, but that many of even the biggest and most successful companies in the world are peculiarly interested in building those relationships, even with what might seem in the abstract to be a rather dull and small and far off Scottish investment management firm. So I think that willingness to invest in the relationships you have with people and to let them know that the world doesn't always go in a straight line, and that even the greatest companies will have periods of both their businesses and their share prices not doing well. And that's something I'd very much encourage other people to think about, because it goes so against the image and indeed the reality of much of the short-term and hedge fund dominated fund management industry as it's portrayed.
That's really interesting. So developing relationships with people then, and understanding businesses, as you said, and really understanding them and the people that are running them. And as you say, the way things change, you don't always have a line that everything always gets better.
Yeah, and I'd almost push that one far enough as to say that I think that means you have to, and I don't know whether I can tempt Sarah's comments. I think you have to be willing to say there are many times when you can't take decisions. And, I think people in fund management take decisions far too often and on far too small a basis, because, very often in the tail of the great investments, it's sticking with them over many times a year, rather than do as stockbrokers and investment bankers do, of constantly want to be changed their holdings and their positions according to the latest wind or the latest noise.
And Sarah, would you like to add anything to that?
No, I think I agree with James that the role of the stockbroker is to get people to trade, and the role of the investor is to hold on to the good companies for many, many years, and their interests are not aligned in this.
Which takes us, I think, perfectly onto the point of our competition. So we're going to throw the doors open to anybody who would like to ask questions. We'd really like to encourage our teams to ask questions. But obviously, in our Growing Future Asset competitions, our teams are researching a company for long-term investment, for exactly that sort of long-term investment that James and Sarah are talking about. And they need to really understand that company, what it does and how it makes money. And what we find is actually that our teams are very good at that. They are very good at researching companies and what they do. Mm-hmm. But we then get slightly evil, and we ask the junior teams to tell us the factors that will make the company grow. And we also ask them to tell us if it will maintain or whether it will increase its profitability. And with the senior teams, who are the sort of S5 and S6 teams, we ask them how big their chosen company will be in 5 years' time. Mm-hmm. So they have to make a prediction. Now, those are difficult questions.
Yes, just the easy questions.
I was going to say, these are difficult questions, even for a professional investor. So, I mean, the question I think that I want to ask, and possibly a lot of our teams want to know, is how do you predict? How do you go about predicting where a company will be in 5 years' time?
Yeah, and I will try and answer that one fairly directly, but I should let you know that in the teams that I've worked with, led, the critical question is probably the second one, which is what happened after the next 5 years. And in almost all great investments, to be honest, stretching that time horizon, and sometimes actually the world becomes more certain rather than less the more you stretch it out to 10, 20, even 30 years is pretty important in this. But I will try and answer. So what we are looking for, and I find this something that it's worthwhile trying to talk a bit about, is for the extremities of performance. people think that the stock market, if you like, is like playing sports, that you score a goal or you fail to score a goal and the distribution is equivalent to that. It's not. Stock market returns are dominated by a small number of extreme companies. So, in the last 20 years, for instance, just 1% of companies have generated all the returns in international stock markets. And you can take that back much further in time. But that's the longest you can get for all countries of the world. So what are you looking for within the next 5 years? Well, firstly, that implies you're looking to see that at the end of that period, there will still be profitable growth opportunities. So, I would stress quite a lot, what do you think is happening at the end of that 5-year period as your imperative insight. But when we're trying to think about those first 5 years, I would stress that even there, you can't predict in the sense that people commonly know about it. So to take an example, when we invested in Tesla back 6 or 7, 8 years ago, in fact now, we thought it was completely frivolous how many investors, and particularly the hedge fund investors, those are people who hated Tesla, believed they could produce a precise map. And what I would absolutely advocate is having different scenarios of the outcomes and trying to assign those probabilities or likelihoods. Now, I know that sounds more complicated, it sounds vaguer, but I think it is actually much more realistic about how the world actually acts. So I would say to you, the most important part of that is then your maximum upside case. And what that requires is trying to force yourself well beyond anything that you can narrowly envisage. It's not, and I would really stress this, it's not an analytical task, it is a creative task. And just very briefly, if I may, I would cite some of the great both investors and business leaders of our time in favor of that view of it. So Michael Moritz, the British venture capitalist behind Google in the early days, said the hardest thing about investing is imagining, and imagining was the word, how great a great company can be. So I think, trying to think about what could really be transformatory. And I think Sarah would be in accord with this. Most times, even when we've made very successful investments, we haven't been nearly optimistic about what the company may do. And very often those outliers determine what your return structure. And then you go through it. Usually we have 4 or 5. And sometimes the bottom one, the worst outcome, is that the company goes bankrupt. We certainly, for Tesla, used to have that. But to cite the other person I wish to build this, Jeff Bezos, right back in 1996, when thinking about Amazon, said, there is this weirdness about every business. Everything gets better and cheaper every year, usually by 50%. Now, he then paused and said, I don't know where that will take you, but I know it's going to be exciting. And I think that's something that, you have to acknowledge in what you're doing. You're not saying this will happen. What you're trying to find out is what might happen and what might be particularly beneficial.
So what the girls then need to be doing is thinking about a variety of different options. So for their company, and we've given them 38 different companies to choose from, they've picked a company. So they need to, when we're asking them what's going to happen in 5 years' time, they need to think, well, it could be this, 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 or this. And what do we think is most likely?
Well, not even the most likely, if I may, and please tell me if this is overcomplicated, but I hope not. Given what I was saying about the returns, the upside case, even if it's only a 5 or 10% likelihood, will matter the most to the valuation of the company. Because if it happens, the company's share price will multiply several times over, even in that 5-year period. So, what I would advocate having these, if it's not too much to ask, is having these 4 or 5 different scenarios for the future. And then at the end, you can multiply out by the likelihood of them happening and see, if you like, what the aggregate likely valuation of the company is, factoring all those different environments. But I would absolutely, yes, warn against you having one map of what's going to happen, one central share price projection, one central earnings projection. And I think that's what so many people get so wrong. We simply cannot have that type of certainty.
Excellent. So, but it really is creative. It's kind of get out your flip chart and think about what the world's going to look like in 5 years' time, and how your business is going to fit within that, which is quite exciting, actually. And it's maybe not something.
I didn't bring it up earlier when you were asking what was good about it, but that is one of the good things about it. It's startling how often you can be amazed and how delightful that can be.
No, that sounds fantastic. So there we go. I think James is encouraging our teams to get out their flip charts and their coloured pens, and to think exactly where we're going to be in 5 years' time, which is fantastic. I've got some questions coming in here. Does James think having a finance background? Well, this is interesting, given your creativeness point there. Does James think that having a finance background is valuable for being a fund manager? Or are other types of training that are beneficial?
Oh, it's a great question. Thank you. I think what you need to be able to understand is enough maths or finance, but not too much of it. I think very few of the truly great investors are mathematical in their background. It can help you, but it's insufficient, as I think you'd probably gather from the previous comment. And the trouble is, if people become obsessed by the maths or the business of it, if they have an MBA or they go through our own trade union's chartered financial analyst qualification, I think that is enough. Whereas what you've just been saying about the importance of the imagination is really what matters. So I think you're much better off, in a sense, adding an adequate financial knowledge and expertise to a much broader set of interests. And coming from a different background is incredibly valuable.
And Sarah, I saw you were nodding along there.
Yes, I think you need to be sufficiently numerate to deal with even just the probabilities of different scenarios and getting all those things put together. So being enumerate would not be helpful in investment, but you don't need to be stunningly financially literate. It's not really that kind of job. It's, as James says, being able to think through scenarios and ask the interesting questions and so on.
Excellent. So Stuart's asking a question here, and he's one of our mentors, and he says, how should the girls be thinking about ESG factors when putting forward their investment cases?
So, and I suspect Stuart knows this, if it's a Stuart I'm thinking it is. My belief would be that ESG is actually much more similar to what we've been talking about in investment, that life is lived in the extremes than people like to believe. So what I think of in ESG terms is not a narrow belief that there is some one best way of running a company, but who can have real impact. And I think there are a very small number of people who can transform our world for the better. I'm sorry, I'm getting caught in using the Tesla example too much. But very often in our stated ESG formulas and formats and what we have to report, Tesla can come out very badly because, after all, it is ultimately a car manufacturer. And that means you have quite a lot of environmental consequences and the like. And it's also a very unusually run company, which various people in the ESG community don't like. But I think it is inarguable now that it has moved the world forward 5 years in adapting to a non-carbon future, particularly in electric vehicles, obviously, but it will become wider. And I would absolutely advocate, Stuart, on focusing on those small number of companies that have extraordinary upside. And there will be a bigger number of them as they emerge and the world changes. But I think getting caught in the weeds and the details is not a good thing. And rather concentrate on those that can truly do good for the world from this point in time.
And we've got a hand up here from Emily. Emily, would you like to ask us your question?
Yeah. Hi, James and Helen. So I've got a question for you, James. So we have to create a pitch for the company, and I was wondering what you think is the most important point to include in the pitch.
Excellent.
Yeah,
So
no, it's very interesting. Well, I'll give you two, and you can select one. I hope that's not chickening out, because I genuinely believe they are both important. And I'll give you the conceptual one first. I think, and it links back to what we've just been discussing about the use or otherwise of finance and maths and investment. I think all the time you should be thinking about, and indeed your company should be thinking about, why can I discern this in a way that no one else can? So I happened last week to be on my first trip to America for 18 months. And I was talking to a company called Flagship Pioneering and their most famous current outcome, which is Moderna, the vaccine company. And if you're either Moderna or Flagship, you are constantly saying, why can't a standard pharmaceutical company do this? Why can't a standard venture capital company do this? And I think you ought to be trying to say, look, what I've realized about X company of those 38, why can I see it? Why can I live with it over the future in a way that other people can't be? So why are you different, and why are they different? The second one would be to go back to what I've been mentioning. I would, Emily, absolutely emphasize the upside potential and that creativity process in it. Sell the dream, because that is the narrative that investors are interested in. What's the real upside here? And I think, that can often sound naive, and many sort of finance types don't like it because they think it's clever to be negative. But be the opposite, be profoundly positive. And I would stress that.
Yeah, so thank you.
That's great. Yeah, thank you very much, Emily, as well. So you've got to be profoundly positive about your company and think about the real upsides. And in terms of thinking, what is it that I can see in this company? How do you come to that? Is it just asking lots of questions around and about that company and what it does?
I think it is, but my impression was always that Sarah and I quite agreed about this. I don't think you should force that process too much. I think you should sort of immerse yourself in ways of thinking and in knowledge of the company, and just let it wash over you for a long period of time. I think people, again, because of the analytical instinct, try to come to answers too early on. And I think you then can apply different mental models, different experiences for dealing with these companies and what you've learned. And, there are so many, you wouldn't believe it, how many conventional write-ups that, frankly, one could throw away as not saying anything of interest there are in finance. So, let it wash over you and then come up with that creative process would be what I would suggest.
Fantastic. So we've got another hand up here, and it says Talia Sasha. I don't know whether that's two people or whether that's one person, but would you like to ask your question? Hello, Talia or Sasha or Talia Sasha.
Hello.
Hello. Ask away.
Sorry, my Wi-Fi's kind of bad right now.
You've got
So I
Wi-Fi
don't know if you can
problems.
hear me.
No, we can hear you.
Yep.
Yeah.
Do you want to ask your question?
My question is, what's the biggest sign to you that a company looks like it's going to grow in the future?
There you go. What's the biggest sign a company's going to grow in the future?
I think you probably are best off by trying to directly ask the company, Talia, what the potential scale of their market is. You can do, again, the analysis on this afterwards, but I think that actually all the evidence suggests, and all the academic evidence does back this up, that it's the scale of the growth opportunity and growth in terms of revenue and sales rather than bottom line earnings that really matters here. So get the company to enthuse you about the possible expansion of their business. And, you know, I've been talking a lot here about the unimaginable nature of it. I'll throw you a different example of what I mean there. So probably the company that's actually had the most influence on me over the course of time is one that ought to be as well known as a company as many of the other ones, but isn't. And that is ASML in Holland, which is effectively the monopolist in providing the very complex equipment that keeps semiconductor industry growing and becoming more efficient. Now, the way they frame to themselves what the opportunity is that they will tell you that they don't have competition, and they told you this well before that was true. What their objective is to outgrow what's known as Moore's Law, which you've probably heard of, which is about the continuous expansion of possibilities of the semiconductor industry. But they trace this back not to when Mr. Moore wrote his article in the mid-1960s, but in fact to 1900. And they say the process of approximate doubling every 18 months has been in order since then. Now, can you imagine going to talk to them or their progenitors in 1900 and seeing where the semiconductor industry would end up 100 years later, 120 years later, and where it might go? I think that's what I'm talking about. I think you're talking about unimaginable scale. And the more that people can throw up their hands and talk about that unimaginable scale, that's the best clue you can have. Of course, being able to build the business on the top of that requires much, but I think that's when you should get excited.
So you say there, James, that ask the company for the scale of their opportunity. Now, there's the thing, and this is something that we've said to our teams, is you can contact the company. You can contact them and ask them. I mean, and they might not reply to you. I hope they would reply to you. But ask them and see what you think. I know of one team at Dean's in West Lothian. They did contact me, and last week they had a conversation with the chief finance officer. So so by all means, give them send them an email.
Yeah, Helen, I think that ties into what I was saying about companies genuinely like it when they sense real interest.
Yeah.
And they find that refreshing. So absolutely.
Fantastic. Thank you very much, Talia. I hope that was helpful to you. Now we've got lots more hands up here, which is fantastic. I'm just going to thank you. You're welcome. Thank you for asking. Leah Hicks, would you like to ask your question?
Oh. Hi there.
Hi,
was just how important is it to highlight trends such as profits, sales, and stock in our future predictions of growth?
Right. And please, if there are various of you having problems with Wi-Fi and muting, please don't worry. One of my great moments during lockdown is that I was chatting to Daniel Ek, the founder of Spotify, and he couldn't make his microphone work. And I thought, well, if he couldn't make his microphone work, we should all feel better about the world. So trends. I would almost say that the more important part of it is the pace of those trends and hence the consistency. What we've tried to do a lot of is investing in exponential growth. And I think the easiest way of approaching this is to think of a chessboard in which you start with 1 grain of salt or of rice, depending on where you come from, and you keep doubling it every year. Now, the trends, the sums don't seem very impressive, but pretty soon they become remarkable in their consequences. So I would worry less, in a sense, about how long or if they are there, but try and boil it down to those very few areas where that exponential possibility does exist, and then become really excited at that point. So, for instance, I was talking about semiconductor growth rates earlier. Well, that's been astonishing in its length and the exponential nature, but it is, for instance, as nothing at the moment compared with the improvement in performance and pricing of sequencing of the genome. Now, that seems to us incredibly important. And if we can keep that 50% going, then it matters. What can you do about that? I think, again, it actually is very often about that process of imagination, but it's also a very factual one. So at this point, I will go back to at least partially to Tesla. Now, we also invest, this is probably since Sarah's time actually, in a Swedish battery company called Northvolt, the bulk of whose management originally came from Tesla. And the CEO of Northvolt said to me that one time when Mr. Musk got even more angry than usual with him at a Tesla meeting, he asked him to try and set out what the difference from the finished production of a Series S to an Atom would make in pricing. Why could you drive it down that much? And how did you get the NES class car ought to cost that much? Now, that's a pretty extreme version of what I'm talking about. But I would keep asking yourself, what is, in a sense, physically possible here? What is the most imagination you can put? No, sorry, that's not the right use of the word imagine. What possibilities? So don't get put off by the ups and downs of it, the variability of it, but see what the potential is. And I think that is something that, though hard work, is very rewarding work and very exciting, to be honest with you. So, I would try and ask yourself again here, the ultimate potential of that trend and the dimensions of that trend.
So you're considering where that trend could go. So yes, you're looking at it, but thinking, where the end point could be. I hope that was useful, Leah. A written question here from Isla, who and she put it in quite early. She said, what is important to say about a company's share graph? So we do ask the girls to find a share graph and to share one of those with us and maybe compare it with one of their competitors. What's important, would you say, to point out about that?
I must confess, I am skeptical about looking at graphs. There are schools of people who are chartists. There are schools of people who think it tells you about relatives within industries. But remember that on the whole, I think that great companies are unique. and therefore you shouldn't be able to find a true comparator. There may be at various stages of development. But I have seen as many companies, and again, I think the data does fit this. I've seen as many companies where the past 10 years of the share price has been terrible, that suddenly become deeply attractive, as I've also seen companies whose share price has been going up and continues to go up. So I would almost go the opposite direction and say, don't look at the share price until the very end of the process. You know, I talked earlier on about the importance of only recording your thoughts later. That would be another thing that I would tend to do with share graphs, is that I would only look later and see whether it makes sense to you. But I would otherwise just encourage great open-mindedness about whatever occurs, whether it's bottom left to top right or bottom right to top left, as to what its meaning is. So I would sort of put in a plea for not paying a lot of attention until the end.
Okay, so that's a really interesting approach, because obviously a lot of people, that is what they do. You know, they do look at those, you know, and that's their evidence, and they want to provide as much evidence as possible, and that's what they're trying to take from the share price chart. But you're saying that the understanding and the belief in the company comes first.
Well, I'll give you a rather, this isn't actually directly a share price, but it's obviously a very similar thing. So I remember in my first week at Baillie Gifford having Sarah data stream graphics shown to me, and what the person teaching us was keen to draw out was a long run graph over the previous 30 years of the pound sterling against the US dollar. And the pound went remorselessly down. And if I was a chartist, or indeed if I'd been a human being at that point, I suspect I would have carried that on for the next 30 years. In fact, and much to my disbelief, the pound has never reached the lows it was at back at that time. You know, so I don't think these things are as immutable as you think, even when they're dealing with big fundamental relationships such as currencies, so let alone share prices.
Okay, so we're going to go back to another written question here, which is, should consideration be taken of the impact of the pandemic and the company's need to have a resilience strategy?
That's a really interesting and really good question. I think that depends on two elements. Firstly, was the company's business resilient enough to be able to make it through without either obviously going bankrupt, but also needing to raise vast amounts of capital? Having to raise vast amounts of capital because of a crisis, whether it be the pandemic or the banking crisis, takes ages to work its way out. And I think, you know, you need to be very careful in that way of thinking through what the finances of a company and what the business of the company can do to survive that. The second one is the internal looking one, that what matters a lot is your own reaction. If you had a company that 12 months ago you were absolutely certain could survive, but you knew the stock market would hate it during the pandemic, then I think it depends on your temperament, your time horizons, as to whether you're prepared to endure that. Obviously, I would be biased to saying you should endure that, but many people have to be honest in saying that they can't cope with the fact that the news will remain awful over the next days. So I think you're asking yourself both a fundamental question and a question about your own temperament there.
Excellent, thank you. Now I've got a question here which might be sort of slightly more targeted towards Sarah, and I'm going to ask this. I see that there's some hands up, and I'll come back to that. But so a question from one of our teachers. He says, can I just check from a competition rulebook answer, when are we supposed to argue our share price case from? He says, by that I mean a few weeks ago when my team picked their company, it was around $615, but now it's around $700. When talking about growth potential, it looks worse if we start at 700. I think we can start when you like.
Yes, start when you like. If you pick the company and it was 615, that's when you pick that one to talk
absolutely. About. Yeah. I don't necessarily think there is a. Well, there you are. I'm glad you're happy with that answer, John. That's fantastic.
We're
But I'm glad so.
really
Being liberal.
judging on the quality of the arguments and these much longer term things that James is talking about, rather than whether the target price that we fundamentally disagree with is, 715 or 730 or something like that.
Absolutely. It's about the case. It's about the case, exactly as Sarah says, it's about the case and the understanding and how the team have interpreted that. So, however, I'm going with the 615. A hand up. Amanda, you've got a question.
Yes. Hello, James. I'm an investment manager, or at least I'm a retired investment manager now. And so mine's a question from a mentor perspective, and I'd love to hear your take. One of the things we have to do is introduce people who have no real background in the stock market at all to the job that we all know and love. And sometimes there are some very basic things that we some words that we think mean one thing and they think mean something completely different. I remember a private client saying that what I really need is income, and what he actually meant wasn't dividend income. He wanted profits. He wanted capital profits.
Yeah.
So I was wondering if you had any experiences that you could share with us of that kind of cognitive dissonances, things that we might want to look out for that you've experienced when talking to people who don't do investment every day, that we might want to make sure that we're getting the right message across.
That's very interesting, Amanda. I got an example, but I don't think it's as quite as narrowly as people who really have not the experience. I think it's one that infects so much, but I think it goes from the completely and understandably unexperienced to those who I would see as being much more culpable. And that's this notion of cheapness or expensiveness of companies. Now, this troubles me because I think it infects both quite a lot of fund managers, but above all, the extremely influential media, which views cheapness as being both the most important element for investment and defines cheapness, which is far worse, about being the multiple of next year's earnings. Now, that's not cheapness. Something can be on 2, 3, 4 times their profits and still be extremely expensive if either it's going bankrupt or if, which is much more common, it's not earning the cost of its capital. And here I'm aware of dangers of introducing difficult concepts, but the valuation of a company is the likelihood adjusted long-term free cash flows. And I know that sentence requires quite a lot of unpacking, but surely journalists working for the Financial Times, Investors Chronicle, whoever else you want to, ought to understand that. And I think that is a deeply sinister part of investing. And so to tell you a story, which at the time Sarah may well have heard me whinging about, I remember in the dark days of 2008-9, of going to see a comparatively well-known and certainly reputed Edinburgh stockbroker who owned some shares in Scottish Mortgage, who told me I simply didn't understand the valuation of markets because I thought that it didn't matter that earnings multiples for 2008-9 looked high. Now, I think, and I can say it with more confidence a dozen years on, that I was right in making that. But I think that is just such a dominant and such a dangerous force in amateurish, but also media and to some extent financial markets assessment. So don't believe the multiple of next year's profits is whether it proves whether a company is cheap or expensive, would be my absolute perennial experience of what you're talking about.
Thanks for that.
You could see various of our investment mentors smiling at that. Emily, you've got another question for us. You've got your hand up, Emily.
Sorry, it's just taking a second to let my camera on there. So I'm just wondering, what made Tesla an attractive company to you in the beginning?
Great question.
Well, I would say there were two genuinely quite simple observations. And to be honest, I would be very excited that you all might be able to throw up quite a lot of analogous potential companies in what you're doing at the moment. So the two elements of it were that even back in 2013, it was clear, and this probably reflects on another question earlier about trends, it was clear that the prices of all the ingredients and components that go into making an electric vehicle were falling at somewhere between 15 and 25% per annum. And speaking not so much here to the company, though we certainly did that, but to all the best academic institutions, there was no reason for thinking that was going to change. Now, if a technology, a set of technologies, is improving at 15 to 25% per annum, when the best that your traditional internal combustion engine companies could do was 2 to 3% per annum, then at some point, if you're patient enough, there is likely to be transformation. The second one was, and we've alluded to this a lot earlier on, both in the Tesla example and the more general one, was the extraordinary ambitions, mental powers, degree of technological understanding that the leaders of the company did have. Now, that's not all easy. We've had plenty of quarrels with Mr. Musk, plenty of sympathy with other people who've left the company because they've had similar quarrels. But if you are trying to transform an industry, you need both to be an outsider and you need to have that extraordinary level of determination and vision. But I don't think that is that difficult to identify. It needs to be somebody from outside. It needs to be somebody with that extraordinary, I guess you'd say, ego in some senses, to be able to attempt that. And frankly, you don't come across that many people there. To take another version of this, and another company we mentioned a lot earlier. At one point, again, as Sarah will remember, we used to have in the early days of the internet almost equally sized holdings in Amazon and eBay. And it was only when the then boss of eBay stood up and said, "I'm no Jeff Bezos," that I think it really occurred to me to realize that no, he wasn't, and that mattered. So I think an awful lot of this, Emily, is about judging people, but those judgments are not actually nearly as difficult as people like to make out. I think there are very, very defined characters that great entrepreneurs have and that they can be identified in advance.
Excellent. So management is key there as well.
Well, I'm sort of, again, this is another one. I'd be interested in Sarah's reaction. I think the word management, Helen, is often quite misleading, quite narrow. I think what that leads to is somebody, again, a bit like investing, thinking of somebody with a sharp pen, being analytical, sort of Jack Welch in the days of GE at the top, rather than GE being dismembered, rather than the visionaries and the people who think deeply differently. So I might refer to a word with management with leadership and culture rather than management per se.
Excellent. And Sarah, do you have something to add to that?
Yeah, I was just thinking almost exactly the same sentence. It's not management but leaders of companies, and particularly in Japan, which is a very conformist society, the most successful companies have been led by people who very much stand out and who usually have had something that really puts them apart. So, as a very obvious example, Mikitani, the leader of Rakuten, founded his online retailer after a personal tragedy, which was the Kobe earthquake, when several members of his family were killed in the Kobe earthquake in trying to think when that was, 1996. And he then decided to stop being a very traditional banker and take his idea and go and found something, before Bezos founded Amazon.
Yep.
Just, so it wasn't that he was copying what was going on elsewhere. He actually had that idea.
No, it's a very good example, as would Mr. Son at SoftBank be, wouldn't he, Sarah? So,
yes, and of course, Mr. is a permanent outsider in Japan because he's Korean.
Mm.
Yeah.
So.
Yeah. The reason I was ill-manneredly interrupting Sarah is that I would suggest to you, though, read the initial shareholder letter of Bezos to Amazon. It is, I think you could almost tell back in 1997, a very great deal about what was going to be on. And you can carry on reading them all the years up until this year if you want a real flavour of how an entrepreneur thinks differently.
We've mentioned letters from CEOs to shareholders in one of our blog posts, actually, to the girls, and we said that these appear in the annual reports. So that gives you a real insight then.
Some
would you
do.
say?
You can tell the difference. Honestly, I would say that if any of the listeners or competitors read that one, those Amazon ones, and then just picked up a company at random, you can tell the difference that exists.
How interesting. Now, I'm conscious of time. Does anybody? I've got one more question which I would like to ask, but has anybody got anything else they would like to ask James or Sarah before going away and getting their flip charts and their coloured pens out and doing a bit of futurology? Well, I've got a question, and that, James, is there a company that you wish you had invested in, or you wish you had invested in earlier? Is there one that got away?
Oh, there are many, and I'm glad you put it that way, because I think your sins of omission is far more important than what fund managers mostly spend their time thinking about it. Ones that have gone up, the ones that have gone down. When people think of mistakes in fund management, they should, as you imply, be thinking of omissions rather than mistakes, if you like. It's not owning things that really matters. Oh, yeah, absolutely. I mean, to be honest, I think as long as one has enough of the really successful companies, that I don't tear myself up about it. What I do sometimes tear myself up about is ones that I had clues too early. And where I gave up too early. So, give you two examples. We've talked a bit about Moderna. Now, Moderna first came into Sears and wanted us to be shareholders as a private company. It took me a long time and into the early days of pandemic before realizing that this was genuinely a unique company. And it's something, I often remind myself of the moment. The other one is, don't underestimate how persistent some of these companies could be. So I spent a lot of time, what would be now close to 5 years ago, trying to puzzle over why that small, little known company called Apple would be able to grow enough in the future. I didn't manage to satisfy myself or my colleagues that it was. So we've sold all our Apple shares approximately 5 years ago. And to go back to your earlier observations about graphs, it won't take much looking at a graph to prove that was a pretty silly decision on my part.
Well, there was one sort of final question, which I think is probably maybe a wee bit of a lesson for life, which is around there will be, what's the word? There will be excitement around some companies, and there will be excitement around sort of, some, and they say everybody should invest in this, and everybody else is kind of running off to buy those. And you suggested, or in an article I read, you suggested that you kind of have to ignore some of that, and you have to sort of believe in your own decisions and not jump on bandwagons. Was that an accurate reflection in the article, or?
Well, think it is both ways round, if I may, and I'm sorry if this is a bit complex for a last question answer. But so there are times when the market becomes an impassioned believer and exaggerators of companies, and in a sense that links back to my answer to the question about not looking at graphs. I think you shouldn't be buying it just because it's going up. But equally, there is the other way around, that I think our industry has a besetting sin of being overly cynical. And I think one of the best traces of that in many ways is look at the short positions, the sales of stock that you don't own by investors. And I think very often that says that the instinctive reaction is to be cynical. And equally, it should apply the other way around. Sometimes you should be enthusiastic, you should be naive, you should fall in love with companies.
I think that's a fantastic point to end on, actually. I would just like to say a huge thank you to James and to Sarah for arranging this as well, for contacting James and asking him to come and speak to you. And a huge thank you to our questioners tonight. I'm delighted to have some questions from both mentors, teachers, and from girls as well. I've certainly found that quite inspiring, and I hope that the girls have found it a really some useful information for their pitches, and we're very much looking forward to seeing those. So that just remains for me to say a huge thank you to James and to Sarah and to everybody else for attending.
Great to talk to you all. Nice to see you, Sarah.
James.
Thank you.